December 12, 2020 is episode 139. I have 6 duplexes. Do I need an LLC? This is a 39.6 Facebook and YouTube Live Finance Show. This is the show that teaches high earners like yourselves how to make your money work for you so you don't have to work for your money. About general investing, taxes, real estate, syndications, Airbnb, paying for college, paying for childcare, and even the car you drive. In today's episode, ask a listener question from Manisha in the 39.6 community on Facebook. She says, I am closing on doors 11 and 12 later this month. Here are the details. Once we close, we will have 6 duplexes, or basically 6 homes, 2 units each. It is the main house, and then there's also a basement which rents separately, and they are all zoned as multi-unit properties. At the moment, they have the 5 duplexes or 5 properties. And of these 5 properties, they are all completely occupied. They are living in one of the units, so 1 out of the 10. Okay, and then once they close on this other duplex, assuming it's rented out, then they'll be renting 11 out of 12 and living in one of them. Okay, none of the properties are currently paid off, but all have positive cash flow. She says, I'm a physician with a low income as I work very part-time, locums only. My husband is a federal employee. Now, I don't know what that means as low income because you're still a physician and physicians still get paid very well, at least as on an hourly basis for the most part, at least on average. And there are some highly paid federal employees. So I don't know what that really translates to. I mean, federal employees only get paid so much. I mean, like the President of the United States makes less than a lot of doctors do, at least as a salary, from a salary standpoint. And this is interesting, a little side tangent. FDA has been in the news a lot lately because of COVID, and the FDA director, Dr. Hahn, actually, he was the division chief over at MD Anderson, where in radiation oncology, where I was a fellow like 6 years ago. We basically just missed paths, but I did get to meet him. But that was like a gigantic pay cut to go from being a division chief of radiation oncology at MD Anderson to becoming FDA director. But I'm sure he's still getting compensated well. Anyhow, she says, do I need to have an LLC for our properties? If we wanted to create an LLC now, I understand we would have to find a commercial lender to pay off the outstanding home mortgage loans. I'm new to all of this lingo and these concepts, trying to understand. Okay. So first of all, let's kind of go through this. So you have, by the end of this month, you're going to have 6 duplexes. Top, main floor, and the basement, 12 units, assuming that 11 of 12 are rented out and you're living on one of them. Okay. I have no idea what the low income is and federal employee. I'm still going to figure this as 6 figures of income. And remember, the passive activity loss limitations come in at a modified adjusted gross income of $150,000. So I'm going to, I don't want to assume anything, but I would think between the two that they're making $150,000. Now, how much of that shows up on the modified adjusted gross income, I don't know. I don't know if she qualifies for real estate professional status or her husband. Probably not her husband because she says that he's a federal employee. Doesn't say that he works part-time, but she does say that she works part-time. So I would assume it's not him, but maybe she does. I don't know. I don't know if she's putting in 15 hours a week in real estate. It certainly could be if you're managing all of these properties. And then, I mean, amongst these doors, probably enough, maybe. I'm assuming you're also doing other investment type activities, but technically those don't necessarily count toward those 750 hours. Anyhow, so we have, if you're under $150,000, then it doesn't really matter as much. You can still take losses, but only up to $25,000. Of course, with real estate professional status, you can take off as much as you can based on the losses. And since they're closing on one more by the end of this year, if they are real estate professionals, they could consider taking bonus depreciation, although I don't know if I necessarily would if the income is low enough already. Like if you're under 100 and like $5,000 of adjusted gross income, you're not even exceeding the 12% bracket. So I don't know if I would even want to do that. This might be a situation where I would want to take the least amount of depreciation this year as possible. Okay. Because you already have all these other doors that are generating a bunch of losses anyhow. So you don't want to be taking losses below zero or in the 0% bracket. That's just a waste. Okay, so do I need to have an LLC for our properties? I always find it interesting when people ask the questions like need. That's kind of like saying, do I need to go to college, right? Because if you think about this whole situation, this person has 12 doors in real estate, but has a quote low income because working very part-time. Now, you can invest in real estate without a college education, right? You could be like a high school graduate or even a high school dropout. And if you know how to invest in real estate, you can find deals, do deals with no money down, find investors, and easily do this stuff if you have the experience education. So I never want to say anybody needs something. Although if you're like making $1 million a year and your company doesn't have like a cash balance pension and you have no employees, that's pretty high up there on like you need to have a cash balance pension. Always possible exceptions. But at the end of the day, what is the purpose of an LLC? An LLC, a limited liability company, is a state level entity. It is not a federal level entity. Okay. When you do your taxes, like LLC is not a tax box. It's a disregarded entity. It can be taxed as a corporation or it can be taxed as an S corp, but otherwise it's just taxed as a partnership or taxed as basically a disregarded entity and flows directly to the owner, okay, or owners. So LLC is to limit liability and is a state level entity, okay? So there's a lot of confusion about these. They do help limit liability, okay? They are not necessarily going to have any impact on your taxes. Now, so first of all, do you need one? The reason to limit liability is to limit how much you can lose, okay? Now you have 12 doors by the end of this year. So I'm going to assume you have some equity across these properties. I don't know where they are, how much they are. Let's just say you're putting in $50,000 per property minimum. I don't know how much it really was. Could be definitely less. We had 3 properties and put in a total of like $60,000 across our 3 single family properties. But let's just say you did $50,000 for each one times 6 properties, $300,000. And I don't know how long you've had them, but let's just say you have $300,000 of equity. Okay, now I don't know how much money you have in other things. I don't know how much money you have in a taxable brokerage account. Okay, I don't know how much you have in a 401k, but remember a 401k, as long as it's not a solo 401k, is ERISA protected. So nobody can really go after that money. So you can kind of think of that money as not being at risk. Okay, it's not subject to creditors really. So that's protected. And how much do you have in checking, savings accounts? How much other debt do you have? You might not have that much equity. I really don't know. So if you don't have that much equity, then you're not really protecting yourself. There's not really much to protect. Okay. Like if you're only worth $50,000, I don't think lawyers are going to get very excited to go after you, right? Or if there's only like $50,000 of equity. But if there's $300,000, yeah, that's probably something that they may consider going after. But if that's all you have, it's still not that much money, to be honest. Remember, lawyers are expensive, and it might not be worth the squeeze. Okay, but the main reason is to limit liability. And if you have assets in an LLC, as opposed to in your own personal name, then you yourself are no longer really at risk, as long as you don't pierce the veil of the entity. Now, if you are self-managing the property, then it also becomes a little bit more complicated, because they could still potentially sue you as like the manager of the property, as opposed to, the asset. It's very complicated. So if you really want to protect yourself, besides doing things like, being good to your tenants, have outside property management manage the property, because then that takes a layer of liability risk off of you as the asset owner. Okay. Because once you start managing the property, at least in my mind, and again, I'm not a lawyer or anything like that, but it puts you at a little bit more risk, especially even if things are inside of an entity. Okay. But certainly having an LLC will help shield your personal assets. So your personal investments, checking, savings, a taxable brokerage account, your own personal house. Okay, now I'm going to get to that. Okay, so you do live in one of these properties at the moment. Okay, so this gets a little bit messy, because the house that you live in personally, you don't necessarily want that property to be titled to an entity. The other properties, sure, but the one that you live in, well, if you're using that as a homestead, at least half of it, and you're deducting or itemizing the property tax portion that is your own personal use on your Schedule A for your own taxes, and the property tax associated with your unit on your property taxes, then you don't necessarily want to have your own property you're living in inside of an LLC, because it's now inside of an entity and it's not really in your own name. So it's like in a business. So that's complicated. So if you live in a property, I personally don't put that inside of an entity. Like the property that I live in right now, we have this title to our family revocable living trust. Even though we Airbnb it, we don't have it inside of an LLC, because we live in it a lot of the time. And we get to deduct all of the personal use portion of expenses in terms of property tax and mortgage interest off of our personal return. So that does not go inside of the LLC. Okay, but we do have, insurance, and it's insured when it's rented out, things like that. Okay, so I would caution you about putting your own property into an LLC. Also, if you are considering going back into one of the properties, you may also want to consider not putting that one into an LLC. For example, the other half of our duplex is titled to one of our entities, but there's a possibility that we may move back into it as early as potentially next year when the tenants move out. You never know. And so then it becomes complicated, because if I move back into it, then we potentially have to take it out of the LLC, and that just creates, I think, more complication. Okay, so these are just things to think about. Okay, if you're going to be moving out of this property and into the new one that you're buying, for example, let's pretend you're buying it on a homestead mortgage or like an FHA loan. I mean, FHA loans, you can get them at like 3.5% or 3.5% down, I think, and probably 3% or less on your mortgage interest on a 30-year fixed. So that is one way to house hack. It is to, get it as a homestead mortgage, move into it, and you'd have to live in there for a year and in at least one of the units. So I don't know if that's the plan, but that's something to consider. However, if you want to take bonus depreciation on both sides, then you wouldn't necessarily want to do that, because then you'd be making it a business property and you wouldn't be living in it. So then you probably wouldn't be getting a homestead mortgage. Okay. But it is a nice way to get something with a very low down payment as a homestead, but you would have to live in it. Okay. So that's some things to think about. So you can have these properties that you're not living in. Okay. You could put them all into an LLC. You could put them into individual LLCs, one for each property. Some people do that. And if you have like $1 million property then that certainly could have its own entity. And if you have a whole bunch of $1 million properties, having a separate one for each one of them is very reasonable. Okay. But if you have like a handful of single family homes, duplexes, getting a separate entity for each of them, it gets to be quite burdensome, just all the paperwork. And I don't know where you're getting your LLC filed in and what the annual cost is of maintaining that entity, because in some states it's pretty expensive. And if you just add on, like, let's say it's $500 a year to renew an LLC, and it's just one property and it's cash flowing $300 a month, well, you just wiped out like almost 2 months of cash flow just on the LLC. So it gets to be, it can be very cost prohibitive, depending how you structure everything. Okay, and then if you have attorneys who are charging you a lot for that, then it can definitely be very expensive. So you need to look out on those costs. So you have to think about how much protection you really need. A lot of people talk to attorneys about stuff, and then they start talking about how you have to create all these elaborate structures. And really, you have to remember how they're getting paid. They're getting paid based on all the stuff they do for you. And so if the more LLCs you make, the more money they get paid, right? So it's easy to get sold on needing to have all of these entities. But a lot of people really don't have that much to protect, to be honest. Now, if you are in a state where you have, or if you're utilizing an LLC in a state that has a series LLC, that's something to strongly consider. We have a series LLC out of Nevada, and you can have like as many series under that umbrella LLC as you want. And so each of our single family rental properties is titled to one of those series. So it's like series LLC or dash series 1 or series 2. And that is for each individual property. And so technically they have their own LLC kind of box within a bigger LLC. Not all states recognize them though, because remember, LLCs are state level entities. Anyhow, we ended up using that. I'm not a lawyer, but it's something to consider. I mean, if your state has them and they recognize them, then definitely something to strongly consider. You can always get an LLC from a different state that does have them, but they may not necessarily be recognized in your state. So it gets very complicated. You could also just have one regular LLC where they're all titled to, and it can definitely make things a lot easier. For me, I have different bank accounts for each LLC, and for our series LLC, we actually have separate bank accounts for each individual series. So the bookkeeping does get to be a little bit more complicated. This is one of the disadvantages of having more entities. It's just literally more complicated. Okay, the bookkeeping is more complicated. Like, let's pretend you have one LLC for each property, and let's say one of them goes cash flow negative for a short period of time for whatever reason. There's a big repair that needs to be done, and you lose your tenant, and it's going to take 3 months to repair this, and you end up sucking out a bunch of cash. Well, that bank account for that one entity may run out, and so you have to start putting in money from your own account or from other LLCs and like loaning money back and forth, and it's just more complicated. Whereas if they were all in one bank account, then even if one of them is cash flow negative, but others are cash flow positive, you don't have to keep feeding the beast cash, right? And then you also have to keep track of like minimum balances in each account. And some banks require like at Chase, it's like $1,500 per account as a minimum. Otherwise, they start charging you like $6 a month. So you have to keep $1,500 inside of each bank account you have. And that just gets to be burdensome. You could have six LLCs and you have like $9,000 just sitting there in cash, which may not be a big deal at all. But if you only have to have one account, then it's only one minimum you need to worry about. Okay. So it's just less cash that's locked up. Now, it says if we wanted to create an LLC now, I understand we would have to find a commercial lender to pay off the outstanding home mortgage loans. Okay. So you don't have to. I don't know when you bought these properties, but rates right now are crazy low. Okay. Now, if you're forming a new LLC, it can also be a little bit more difficult to get a commercial lender to give you a good mortgage at a good rate because it's a new entity without much money in the bank, without much history, etc. But certainly, it is certainly possible, especially if you're working locally with a local bank who knows those properties, knows that area. You could do that. You could first transfer them to the LLC. Okay, so in where I am, we use warranty deeds. There's different kinds of deeds, but we use warranty deeds, and it's very state specific. Definitely talk to like a title attorney who knows what they're doing. Work ideally locally, and get it titled so you can get it transferred to your LLC. Now, you really want to keep track of the books when you do this, like know how much money you have put into that property before it gets into the LLC, like your cost basis. It's just something you want to keep track of when you do that transfer, because trying to figure out this information later on when the property sells is a lot more complicated. So the better the records you have from now and then at the time of the transfer, the better. Okay. But you have that property that's transferred. It has the old mortgage on it. Okay. So what would happen is the title gets changed, but the mortgage is still in your name or your husband's name or both of your names. The mortgage company, technically, if the property is transferred to a different entity, it's like it's been sold, kind of, and the name does not necessarily match up between the title and the mortgage. And if they know that you have transferred it, they can activate what's called the due on sale clause. Due as in DUE, like pregnant baby due on sale clause. It's not really a sale, but it kind of looks like it because the title has changed. If they decide to act upon that clause, which is in the mortgage statement, basically any homestead mortgage or even rental property mortgage for a single family property or duplex, whatever, will have that clause. So the bank has the right to say, hey, you transferred this. You got to pay up now. You got to pay off the remainder of the loan. I have never known anybody personally to have had this happen. And we have done this on our properties when we transfer them to our series LLC. We did not get any notification from the bank. They were not upset with us as far as I know. We just kept paying our mortgage and they've been happy. However, it is possible, and I have heard indirectly from somebody else that they knew somebody else that this happened to, at least maybe 2 occasions, and this is a guy who knows a bunch of people in real estate. So very, very, very unlikely, but it is not a 0% risk. Okay, there are a lot of other risks in the world. It's not something that I get too worried about personally. But again, talking to commercial lenders is something definitely to consider, especially if they can give you, better terms or good terms. You might not be able to get like a 30-year fixed. You might have to settle for something with more of a variable rate, but you could get your rates a lot lower depending on when you bought these properties. And so it is something to consider. And once you have that relationship, it's easier to continue scaling, because if you're just getting things in your own name, after you get to like 4, it gets more difficult. You could have 4 in your name, 4 in your spouse's name. But after that, you really need to have like a portfolio lender who will lend to you, and you're already basically approaching those numbers anyhow. So it's something to strongly consider and develop that relationship. It may be easier to just basically use one LLC, or one series LLC, because with the series LLC, they all have the same EIN number, tax ID number, and that may help get some more credibility with getting credit from lenders. Okay. So these are things to think about. But if you don't have a lot of equity in these assets, it's very reasonable to put them all in the same one for a while until you have a lot. Like, okay, let's say you have like 12 doors. Okay, that could all be in one LLC. And especially if you accumulated these all within a certain amount of time, like 2018, 2019. Then, or sorry, 2019, 2020. And then maybe in 2021, then you have a new LLC starting now, or starting 2021 for all the properties you're going to acquire in the next couple of years or so, up to a certain number of properties or a certain amount of equity in there. Okay, things to consider. But again, you don't necessarily need to have an LLC. If you have this many units though, I definitely would in general, because it's not that hard to have at least just having one LLC is pretty simple. It really won't change your taxes at all, because if it's just a single LLC and it's a single member LLC, then it's just a simple pass through right to your Schedule E. Okay, the same way that it is right now. I don't know what state you live in, but if you live in a community property state, from my understanding, because that's how it is here in Texas, if you and your spouse are the owners of that entity and own real estate, even though technically there's 2 people on that LLC, you can still file this as a disregarded entity and it goes straight to your Schedule E. That's my understanding, because in a community property state, it doesn't really matter if you're married or individual. But if you're not in a community property state and the LLC has 2 owners, for example, you and your spouse, then my understanding is that you have to file your taxes now as a partnership and file a Form 1065. That 1065 will give you 2 K1s, one K1 for your spouse, one K1 for you, 50% each, assuming you're each 50% owners in that LLC. Now, one of the other things you can consider doing with an LLC, assuming you want the ownership to be just you and your spouse, you can consider also throwing in like a tiny other owner, like a 1% owner, to be somebody else. Maybe like one of your parents, or maybe somebody you're not related to. Because then your LLC now has ownership from unrelated parties. Okay. And that is one thing you can do to potentially improve the asset protection a little bit, because it's no longer owned just by like a person or a family. Now it looks more like a business, and it's harder to go after your personal assets when there is a business that's owned by multiple unrelated individuals or just multiple individuals. Okay, it's kind of like if you have a solo 401k or an individual 401k, technically that's not ERISA protected, at least at the same level that a regular 401k is from your job. And things are different from state to state, but ERISA protection is like asset protection at the federal level. If you have an individual 401k, it's just you. Okay, so it's easy to kind of like pierce through that veil of that protection. But if you have a 401k through a company with other people who work there, that 401k becomes now like more protected. And so the same thing can be thought of at the entity level. If you have other people in there who, even if it's like 1%, now it kind of looks more like a business and not just an individual. Because just filling out paperwork and making an LLC, it doesn't just give you magical protection. You have to treat it like a business and not pierce the corporate veil. If the corporate veil is pierced, then it's really just you with this like mask in front of you doing the same thing. And if that's pierced, then all of your protection basically fall apart, and you've done all this extra work, all this extra cost, and doesn't really help you. So it is something to potentially consider. There's also way more complicated structures besides just having an LLC or series LLC. You could have a limited partnership. You can have trusts and very complicated stuff. But for the most part, I mean, having one LLC and having everything in there is probably a very reasonable, good first step. It really depends on how much risk you're willing to take, and how much you really have at risk, and how likely it is to, get a claim or get sued, for example, and have to worry about your liability. But if you don't really have much in the way of assets to protect, it's very easy to get so bogged down in doing all these things to protect your assets that you end up not investing and not doing things just because it's more complicated. And then it doesn't really get you anywhere. It's just self-defeating. But having one LLC and having everything in there, probably pretty reasonable. And then going forward, you can title things to that. But I think a great compromise is if you have a series LLC that is recognized by your state, to strongly consider that. Okay, I think that's enough. I talked about that, gosh, super extensively. Last was, I might have said it. After you title them, then you can consider like refinancing them all, or potentially all refinancing them all in the process. I've never actually done it that way, but definitely something to consider and look at while you're doing this. And also, if you're going to close on a property at the end of this month, you may want to consider buying that property directly inside of the LLC, because you can get an LLC opened up within a couple of days. It's not that hard, especially if you have an attorney write it up for you. Get it probably within like a day. And then just change your closing documents, your contract, to title it to the entity. And then it's bought directly by the entity. All right. That's it for this one. I think I answered that one pretty extensively. Okay. That's it for today. Episode number 139, December 12th, 2020. Until tomorrow for episode 140. Please ask your questions in the Facebook group. Invite your friends. This is not legal, not financial, not professional, not accounting, not any sort of advice whatsoever. Strictly my entertainment, hopefully yours. Until then, have a good night.